Hi, I'm Mike Burnick, the new editor of International ETF Trader for Weiss Research, and I'll be joining you here on Money and Markets TV every Thursday. If you've been following the markets very closely, you know it's been a white-knuckle ride this summer. The Dow Jones Industrial Average dropped 800 points in the month of May alone, followed by a 700-plus point rebound since June. And of course, we still face widespread uncertainty as investors try to deal with the global economic slump, the approaching fiscal cliff, the upcoming U.S. elections this fall, and of course, the seemingly never-ending sovereign debt crisis over in Europe. Amid all this volatility, investors have been seesawing between risk-on and risk-off mode all year. And in this kind of schizophrenic market environment, it's extremely important to detect those shifts in sentiment and market trend early and try to get ahead of them, if at all possible. That's why I've created a custom index that I call the RoRo indicator, short for risk on, risk off. Simply take the Standard & Poor's Consumer Discretionary Stock Index and divide it by the S&P Consumer Staples Index. When discretionary stocks, like Amazon.com for instance, are performing better, the index goes up, indicating positive investor sentiment and consumer spending. And when staples companies like Procter & Gamble or Coke, for example, are outperforming, well, this means investors are seeking more safety in a risk-off stance. And the RoRo index goes down. As you can see here in this chart, consumer discretionary stocks had the upper hand from September of last year through this past April, indicating a risk-on environment in markets. During that time, aggressive stocks and commodities outperformed more conservative strategies, and the S&P 500 gained nearly 20% over that period. But about 3 months ago, we switched back into risk-off mode again, with consumer staples outperforming discretionary companies by a wide margin. The S&P 500 has still been going up, but only about 2% over that period of time, and this tells me that many investors remain unconvinced about the health of the U.S. economy and the strength of the market. In fact, $71 billion has been pulled out of U.S. stock mutual funds so far this year alone, and this could mean a couple of different things for the market moving forward. First, this extreme one-sided negative sentiment could be a positive, a silver lining. It could mean that much of the bad news has already been priced in at this point. But on the other hand, it could also indicate just how jittery and cautious investors have become, and another market correction could be coming. So which is it? Well, I think we'll get an answer by looking at how the different sectors perform in the weeks ahead. If the bullish move is going to continue, we should see the rally broaden out to more economically sensitive cyclical sectors such as technology, industrials, and of course consumer discretionary. But if we see the cyclical sectors not performing so well, if they fail to participate more fully, that would signal to me that there could be more trouble ahead. Perhaps the easiest ways to get clues of the market's direction is to closely watch a few exchange-traded funds. One, the SPDR Select Sector Consumer Discretionary ETF, symbol XLY, and the SPDR Select Sector Consumer Staples, XLP. The Consumer Discretionary ETF was one of the best performing funds through much of this year, but with the shift to more of a risk-off environment recently, it's been struggling to keep pace, getting outperformed by some of the more defensive ETFs. Now, if XLY can break out above its recent highs and resume more of a leadership role, that could signal a return of the risk-on trade and give the market another leg up. I'm Mike Burnick for Money and Markets TV. Thanks for watching and good investing.